These days, when people talk about inflation, they often want to know why the Fed is doing what it's doing and how to invest in the current environment. My goal here is to try to explain the answer to the first question. And to do this, I will try as much as possible to stick just to the facts. I'll avoid giving you my opinions as much as possible, although I have a lot of opinions. And for the same reason, I'm not going to try and answer the second question at all, because I would just have to give you opinions for that one. Nevertheless, I think in order to understand how to invest today, you need to understand the answer to the first question. The details really matter. And that's what I'll attempt to explain here. I hope to convince you that the problems that we're experiencing now with inflation are not just a result of events in the last 2 years. They're not just a result of the pandemic. They're a consequence of fundamental features of our banking system that have been evolving for at least 100 years. And in the last 15 years, there have been serious events, big events that have occurred in this banking system that have led us to this point. And I'll talk about those events. In some sense, and this is now an opinion, my feeling is that inflation is sort of unavoidable. All roads lead to inflation. No matter the choices we have made, mean that we would either experience inflation or another kind of catastrophe. Okay. There's sort of, and I hope you'll understand what I mean by that. All right. So here's an outline of what I'll talk about. I'll start by discussing the basics. I'll talk about money, our banking system, and how lending happens in our banking system. Then I'll talk about the role of the Fed in the system during normal times. And finally, I'll talk about what the Fed has been doing during times of crisis. And all throughout the story, inflation will keep playing a role. Okay, it will constantly be about inflation and trying to avoid inflation. So let's start first with money. So here's a curious fact about money. If you went out today and tried to count how much money is at banks, you would end up with two different numbers based on how you decided to count. If you counted all of the money that's held at the banks, held in bank vaults, you would end up with a number that's something like $3.2 trillion. But if you counted how much money there is in bank accounts, you would end up with a much larger number. You'd end up with $21.7 trillion. And let me explain why this is the case. To understand this, you need to think about money the way bankers think about money. And they think of money as coming in two different forms. There are two kinds of money. The first kind is the money that you can touch. This is the form of money that most of us think about when we think about money. This kind of money is called central bank money, and it can only be created by the central bank, which is the Fed in the United States. The second kind of money is called commercial bank money, and this is the money that's in your bank account. And this money is created by commercial banks. So let's say someone deposits $50 in a bank. The bank creates a bank account which has $50 in it. At this point, there's $50 of central bank money and $50 of commercial bank money. There's no discrepancy between the two numbers. But if the bank decides to lend money to someone, then there starts to be a discrepancy because they just gave $50 of the central bank money to someone else, so it moved outside of the bank. But this account here still contains $50. Okay, so there's a discrepancy between the amount of money, the central bank money of the bank and the commercial bank money of the bank. The person who borrowed the money might deposit that money in another bank, and now we have a total of $100 of commercial bank money in the system and only $50 of central bank money. Okay, so this is at the core of why the two forms of money are different. if you think about this, you realize you don't really need a second bank to have this discrepancy. That the person borrowing the money could deposit the money back into the same bank, and you would still have this discrepancy. And in fact, it's the way this works in practice. The loans don't involve central bank money at all. When someone wants to get a loan, the bank just creates a bank account and adds $50 to that bank account, and that is the loan. All right, so that's how loans work, and loans create a discrepancy between the two kinds of money. Now, you might be tempted to think that this form of money, the commercial bank money, is not real money. Okay, it's just a number in a bank account, and it doesn't have any meaning. But a very key thing to understand here is that our financial system has been designed so that this form of money actually is almost equivalent to this form of money. I'll explain how the commercial bank money is actually guaranteed by the Fed. The Fed ensures that it is always possible to exchange commercial bank money for central bank money. And that elevates the stature of commercial bank money to be equivalent to central bank money, or nearly equivalent. You can form your own opinion about that. Okay, and I'll explain that in a few minutes. But for now, take my word for it that this is actually more or less the same as this. Now, if you think about what's going on here, you realize that the gap between the two kinds of numbers, two kinds of money, increases as lending increases. So if there are lots of outstanding loans, there's going to be a bigger gap between the two types of money. And as loans are repaid, if lending decreases, then the gap also goes down. Okay. So the difference between the two numbers, the two forms of money, has to do with the number of outstanding loans in the system. Now, the system I've talked about so far already leads to some major headaches that we need to handle. The first is you could have a lot of inflation. Because as we've designed it, commercial banks are just able to generate their, money in people's bank accounts. So if they did this in an unrestrained way, they could just generate huge amounts of money in this way. And that could cause inflation. It could cause prices to go up. And if there is a lot of inflation, that's a serious problem because it would undermine people's faith in the value of the currency. And nobody wants that. Everybody wants to trust that the currency has a meaningful value that does not go down dramatically over time. The second kind of problem is that defaults are a major problem. If you think about what happens in the system, if someone is unable to pay their loan back, then the gap between the two kinds of money becomes permanent. I'll talk about that in a few minutes. The third kind of problem is that we could have bank runs. If people show up at the bank and they want to withdraw their money and the bank does not have enough central bank money to satisfy those requests, there could be widespread panic. All right, so we need to now have mechanisms to deal with all of these headaches, and I'll discuss what they are. But before I do that, let's look at the actual numbers. So here's a picture of the counts of the amount of commercial bank money and the amount of central bank money in the system at banks. Okay, so the red line is the amount of commercial bank money at banks, and the blue line is the amount of central bank money held at banks. And you see that sure enough, there's a big discrepancy between the two numbers. At present, the amount of commercial bank money is almost 7 times bigger than the amount of central bank money held at the banks. All right, so one way we've tried to address the inflation problem, we've tried to restrain the banks from creating arbitrary amounts of money, is by having regulations that enforce a reserve ratio. This means we require the banks to hold at least 10% of their deposits in commercial bank money. Okay, that's an example of a reserve ratio. Now, these regulations, they sort of change quite often. So this number 10%, goes up and down based on how regulators, based on what regulators are thinking about. So next, let's talk about defaults. Let's say the bank makes a loan to a guy named Jack, and let's say Jack decides to go out and buy some beans, and those beans turn out to be worthless, so now Jack is unable to pay back his loan. Right. This is now a serious problem because, as we discussed, the gap between the central bank money and the commercial bank money is related to the number of outstanding loans. And if we reach a state where this loan will never be repaid, then that causes a sort of a permanent discrepancy between the amount of commercial bank money in the system and the amount of central bank money in the system. And if this happens on a very large scale, if a lot of people default on their loans, then we might be in serious trouble, because this makes the gap between the two numbers permanently entrenched. And one thing that could happen is, if this gap becomes so large that it hits the reserve ratio, then commercial banks just are unable to issue new loans because they would violate the reserve ratio. Now, we could change the reserve ratio, that's just a law. But if we do that, then we're just going to increase the amount of money in the system even more. So we could then have inflation and a loss of trust in the currency. Okay, so all of those outcomes just sound terrible. So for this reason, bankers and people at the Fed really do not want to see large-scale defaults. Okay, that is a major threat to the entire financial system. It's a threat that goes beyond just the people, the bank and the people involved in the default. It affects everyone, because it really affects trust in the currency. All right, now I'm going to talk about bank runs in a little bit, but before I do that, I need to explain one more feature of loans that's important to understand. And that's the fact that loans themselves can be bought and sold. And to explain this, I want to illustrate this by describing how the US government borrows money. So here's a picture of the US Treasury. This is the agency that manages the accounts of the US government. It's the agency that collects taxes, spends the money of the US government, and borrows money for the US government. And it should not be confused with the Fed. The Fed is a bank that's supposed to be independent of the Treasury. The Fed is the only agency that can actually create currency. The Treasury cannot create its own currency. The Treasury has to either borrow or raise the money that it spends. So how does the Treasury go about borrowing money? Well, it does it using a contract that's called a Treasury note, bond, or bill. So this is just a contract that says, it's a contract that's maybe, say, worth $100 at some point in the future. And it takes this contract and sells it at auction. So a bunch of people show up to the auction and bid to buy this contract. And say, this person buys it for $98. This gives the Treasury some hard cash to spend. This contract itself can be bought and sold in the open market. So someone else can buy this contract. And when the date that's written on the contract shows up, the person that's holding the contract can redeem it with the Treasury for $100 for the face value of the contract. So this entire process executes a loan for the Treasury. And the key point is that the contracts themselves, the Treasuries, can be bought and sold in the open market. The same thing happens with mortgages. When you go out to get a mortgage from a bank, the bank gives you some money and you start making mortgage payments. The mortgage itself can be bought and sold. So the bank might sell that mortgage to someone else or some other entity and then your mortgage payments go to that new person. All right, so those are some basic features of our financial system, and now I want to talk about the role of the Fed. The first thing that the Fed does is it guarantees that withdrawals always succeed. Okay. So let's say you had a bank that was in this situation, that the amount of central bank money that it had on hand was not enough to satisfy someone's request for withdrawal. Okay. Now, in the old days, if this was 1900, this situation would lead to a run on the bank.
Give me back my money!
There's something wrong. The bank won't give someone their money.
Well, I'm going to get mine. Come along, young man. Every penny in yours.
And mine too.
And give me mine, too.
Stop all payments! Stop all payments!
But these days, we don't have runs on the bank because we've changed the system. We have the Fed. We have the Fed that solves this problem. And let me now briefly go over the history of how we came about with the Fed and came about with the system. So here's a brief history of the central banking system in the United States. Prior to 1791, we didn't have a central bank, and governments were actually issuing currency. In fact, state governments were issuing currency. And, this didn't work out so well because governments just printed massive amounts of money as they needed it. And that led to loss of trust in the currency that they were issuing and very high rates of inflation. And so in 1791, the first central bank was created in the United States. In 1907, there was a major panic in the financial system when there was a large run on the bank. Okay, and that led to all kinds of turbulence in the financial system. The stock market dropped by 50%, and over a number of years following that panic, Congress stepped in to try to regulate and solve this problem, and they created the Fed to try and address these issues. In the more than 100 years since 1913, the role of the Fed has evolved. New regulations and changes have been made over and over again to the role of the Fed until we've reached the current Fed. And the current Fed is tasked with two major goals. It's called the dual mandate. They're tasked with trying to maintain low unemployment in the economy and also to maintain inflation at the rate of 2%. Okay, so those are the goals of the Fed, along with maintaining financial stability in the entire system. So now let me explain how the Fed, in the present day Fed, is able to prevent runs on the bank. So suppose we're in the situation, as I described before, the bank doesn't have enough money to satisfy the withdrawal. The Fed steps in. The Fed provides a loan to the bank that makes up the difference. And now the bank is able to pay out the customer. The customer notices no difference. They get their cash. And the Fed makes this loan at a particular interest rate, and that interest rate is called the Fed funds rate. This is the rate that you've probably heard about in the news quite a bit. Now, if the banks have excess cash on hand, they're also able to deposit this cash at the Fed and earn interest at the Fed funds rate. Okay, so this Fed funds rate, which the Fed just decides what it is a really key knob that the Fed can use to control the entire system. Because if you think about what's happening here, there's the Fed and all other entities in the system. The Fed is the only entity that's able to generate central bank money. And as the Fed increases the Fed funds rate, it reduces the amount of commercial bank money generated on this side of the system, right? Because the commercial banks are incentivized to make fewer loans so that they have to pay less interest to the Fed when they borrow from the Fed, and also incentivizes them to make fewer loans because they can deposit their excess cash and earn the Fed funds rate from the Fed. If the Fed lowers the Fed funds rate, it incentivizes the banks to generate more commercial bank money. All right? So the Fed funds rate, that's why the Fed funds rate is so powerful. It sort of dictates how much money there is in the entire system. Okay, so finally, let's talk about what the Fed has been doing in the last 15 years during the last few financial crises that we've had. So let's start with the great financial crisis of 2008. Now, this is a very complicated financial crisis, but for our purposes, what happened is that home prices crashed. And when home prices crashed, mortgages crashed as well. And there was a threat that there would be large-scale defaults in the system. And as I discussed, that's a problem not just for the banks and the people involved with those loans, but for all of us. That's a threat to the entire financial system. So the Fed decided to intervene. And how did they intervene? Well, here's the solution they came up with. They tried to go out and just buy all of the loans that were likely to default. And this solves the problem of creating a discrepancy between the amount of central bank money in the system and the amount of commercial bank money in the system, because they've just injected central bank money to make up that gap. Now, if you see, even if this loan defaults, there's no permanent discrepancy created between the two forms of money in the financial system, on this side of the picture. So this solves that problem of the discrepancy, but of course, in order to solve this problem, they had to inject money into the system. So there is a very high risk that this would lead to inflation. So the Fed actually took many actions to solve this problem. They tried to prevent the default. So they lowered the Fed funds rate to zero to try and encourage banks to lend even more. And then they went out and bought all of these loans. This was done under the quantitative easing program. That's the name of the program that they came up with. And they did this on a massive scale. In a very short amount of time, they spent $1 trillion buying loans, buying treasuries and mortgages in the open market. Okay. All right, so that was the great financial crisis of 2008. What about the pandemic? Well, when the pandemic started, we were again in a similar situation. The financial markets crashed, and there was again the threat that there would be large-scale default. And again, the Fed felt that it had to act. So what did it do? Once again, it dropped the Fed funds rate to zero. The Fed funds rate had been raised in the 10 years between the previous financial crisis and the pandemic. It dropped the reserve ratio requirement to 0%. It's just trying to encourage banks to continue lending. And it went out and bought even more debt. Again, it bought a whole bunch of treasuries and mortgage-backed securities. And this time, they actually, in a very short amount of time, they went out and spent $3 trillion buying treasuries and mortgage-backed securities, which are just basically mortgages. All right, so here's a picture of exactly what they've been doing in the last 15 years. This graph here shows the assets of the Federal Reserve. Namely, it's the value of all of the loans that they're holding over the last 15 years. And you can see that there's a jump here of $1 trillion that corresponds to what they did during the Great Financial Crisis. And there's a jump here of $3 trillion, which is what they did in 2020. Okay, and between 2020 and 2022, they added in an additional $2 trillion of central bank money. So this is a picture of all of the value of the assets held by the Fed, but you can also think of it as a picture of the amount of central bank money that the Fed injected into the system. All right. Now, it can be very hard to understand exactly how big these numbers are because, 3 trillion is so large that it's hard to conceive of what it is. But one way to get a handle of how big they are is to compare them to other large numbers. So let's do that. So here's a comparison of how big these numbers are compared to the total amount of money that's out there. The red line again is the amount of commercial bank money out there. The blue line is the amount of central bank money that's held at banks. And you can see that at the time that the Fed injected $3 trillion, there was only $15 trillion of commercial bank money out there. So they actually inserted about 1/5 the amount of commercial bank money in new central bank money in a very short amount of time. So this is a really massive amount of money. We can also compare these numbers to the GDP of the US. So here's the GDP. Right before 2020, the GDP was about $21 trillion. So the amount of money they injected here is about 1/7 of the GDP. Now, most of the money that was injected was used to buy treasuries during this last 15 years. So here's a plot of the value of the treasuries held by the Fed. That's the line in the black. And at this point, it's about $6 trillion in treasuries. The difference between these two is mortgages. That's the remaining kind of asset that's held by the Fed for the most part. And just to understand how much of US debt is held by the Fed, here's a comparison of the amount of treasuries held by the Fed to the amount of treasuries held by other major institutions. The red line here is a graph of all treasuries, okay? And the blue line is the value of all of the treasuries held by foreign countries. When the US sends money outside, when we trade, we maybe buy things in dollars, those dollars end up in the hands of foreign governments. And the governments don't hold those dollars just in cash. They mostly take that cash and use it to buy treasuries, to invest it in treasuries and hold the treasuries instead. The total holding of all treasuries in all foreign countries is about $7.4 trillion at present. And the Fed is holding $6.2 trillion in treasuries. Okay, so that gives you an idea of the scale of the Fed action. How did the Fed come up with these numbers? How did they decide how much to inject? Well, of course, the major downside of injecting so much money is there's a risk that there would be high inflation, right? The currency could be devalued. So it was quite a controversial decision in 2008 when they injected $1 trillion in such a short amount of time. But what ended up happening is that if you looked at the inflation of consumer goods, which is the thing the Fed cares about, inflation in consumer goods, there was somehow not much inflation after this Fed action. Okay, inflation in consumer goods had been as high as 15% here. Oh, I should say that in this picture, the amount of money injected here is corresponds to the left, the numbers here on the left, and the percentage of inflation corresponds to the numbers here on the right. And you see that inflation, at some point in the 80s was quite high, and then since then it's generally gone down. And even though the Fed inserted so much money, inflation stayed roughly below 2% for about 10 years. Okay, so it seemed like this action, this Fed action, did not lead to a lot of inflation, at least in consumer goods. If you look at home prices, then the story is a little bit different. So here's the inflation in home prices. Again, it's the percentages are on the right. The picture has changed a little bit because home prices have been inflating quite a bit more than consumer goods. And you'll see that for most of the last 10 years, home prices have been growing at the rate of about 5%, okay, which is much higher than the prices of consumer goods. And after the pandemic, after this latest action, consumer goods have exploded in price, right? And home prices have had an even bigger jump. If you look at the prices of stocks, which is now plotted in this green line, you see that those also have been inflating at a very high rate. In fact, for much of the last 10 years, they've been increasing at the rate of about 12 to 17%. And during the pandemic, as we all know, the stock market exploded. Okay, it's now falling, but it went up pretty high. All right, so this picture here is the reason the Fed decided to act so aggressively during the pandemic. The history for the last 10 years had shown that injecting this amount of money did not seem to have much of an effect on the inflation of consumer goods. And that's what gave them the confidence to go ahead and make such an aggressive move in the last 2 or 3 years. All right, so that's the story. So what is the Fed doing now? And why is it doing that? Well, it's just simply trying to reverse some of the decisions that it's made in the past. Okay, it's going to reverse quantitative easing by running the quantitative tightening program. The idea here is just to sell the treasuries and mortgage-backed securities that it's holding, the treasuries and mortgages that it's holding, back into the market. And it's going to do this at a pace of $1 trillion a year. And in this way, it's going to be taking central bank money out of the system. Okay. And it's also raising interest rates. Both of these actions are aimed at trying to reduce the amount of money in the system. And the idea is very simple. It will reduce the amount of money, and if enough money is taken out, prices will come down, and inflation will be solved. Okay. But don't just take my word for it.
And let me say, we've written down what we think is a plausible path for the federal funds rate. The path that we actually execute will be enough. It will be enough to restore price stability.
That was the chair of the Fed, Jay Powell. And the reason he's so confident that inflation will be brought under control is because it's very simple. The Fed is able and willing to take out a lot of money from the financial system. And if they do that, inflation has to come down. All right, so now let me turn to a few frequently asked questions people ask me when I discuss these topics. The first question that people often ask is, if the amount of money in the system has been changing so much, why don't we see the effect of that on exchange rates between currencies? And the reason it's hard to see it in exchange rates is because all of the central banks in the world have been coordinating their actions. When the Fed went out and did this, it didn't just do this unilaterally. It went out and talked to all the other major central banks in the world, and they all worked together to figure out how to do this in a way that would not disrupt the entire system. So here's a picture of the assets owned by the European Central Bank in red and the assets owned by the Japanese Central Bank in blue. And you'll see that those two central banks have also been injecting huge amounts of central bank money into their systems. Okay, so that's why it's hard to disentangle, to see a clear movement in exchange rates. Something very interesting is happening now in the last 5 or 6 months, which is that the coordination between the central banks is broken a little bit. While the Fed is pulling money out, the Japanese central bank in particular has been very adamant that it's going to continue injecting money into their system. And so we're starting to see some interesting moves in exchange rates because of that. The next question people often ask is, what about all of this government spending we've seen, these huge programs passed by Congress into law that spent a lot of money? Well, that's, in my mind, quite different from what I've been talking about here. Because when the US Treasury, which manages the money of the government, goes out and spends money, it has to raise that money. Okay, it can't just create money out of thin air, which is very different from the Fed. The Fed can make its own money. And that means that one way or another, when the US Treasury spends money, it's just taking money from one part of the system on the right and pushing it to another part of the system. And that might have an effect on inflation. I don't know. That's open to debate. But it's quite different from the spending from the actions taken by the Fed. And the last kind of question people ask me is, what do you think about Democrats, Republicans, and Congress? Who should be held accountable for the problems that we're experiencing now? You know what? Let me tell you what I really think.